Thank you, and good afternoon, everyone. I'd like to start by just trying to get a little bit familiar with the audience here. And so I'm wondering how many of you are from counties with a population of less than 150,000? Okay. Well, that's good. That'll help me gear some of my comments toward that level of governance. Now, how many from counties between 150,000 and 350,000? And how many folks are from counties that have more than 350,000? Okay. And how many of you are from charter counties? Okay. How many of you have served on elected boards before, city councils or any other type? Okay. Have any of you served in the legislature? Okay, well, thanks. I'm going to step out from behind the mic here, so please let me know if you can hear me. Can everyone hear me? Okay, good. So we're going to talk about budgeting for a while, and y'all have not been through a complete budget process yet, but it's coming up soon, and this will hopefully help you understand what you're facing when you get into the budget process. You know, there's only one thing that a county commission has to do each year. There's one thing that the statutes require you to do, and that's adopt a budget. There's nothing else that you have to do throughout the course of the year, according to the statutes, but you do have to adopt a budget. So to give you a little bit of an overview, we're going to talk about the budget policies and the budget process, the basics of a budget and budgeting, the legal requirements that you have to follow, including the truth and millage process, a typical budget calendar, and the commissioner's role in the budget, which can vary, but I'm speaking in generalities. Overall, the budget process is not always a linear process. Things can be happening at the same time, or some things might happen earlier than you might expect, and then suddenly you need to go back again to take a few steps back in order to get on another track or whatever track you want to move to. You know, one of the questions you ask is, well, what product are we trying to create? And to create this product, what series of activities need to take place? What information do we need? How do we review it? Where do we get it from? Who is involved in the process and what role do they play? What time frame and deadlines do we have? What legal requirements must be met? And what happens after the budget is adopted? I'll be covering all these things. First, generally speaking, the budget should be based on legal requirements and best practices. Generally, the legal requirements for county budgets are spelled out in Florida statutes, Chapter 129. There's other budget requirements spelled out in Florida Statute 200.065, and those requirements are not just for counties, they usually apply also to school boards and local governments. But Statute 129 is the county budget statute. There are a number of places where you can find best practices for budgeting, but the most prevalently used one is set forth by the Government Finance Officers Association. And you have to set up your budget so that as you begin to implement your budget, you can comply with generally accepted accounting principles, which I'm not necessarily talking about here. I will refer to it a few times, though. Florida Statute 129 says that a county budget must be balanced. It also defines the budget system and the fiscal year. It defines the process and provides general guidelines as to how the budget should be set up. One of the things that you'll notice when you look at county budgets and when you look at the advertisements that are published in accordance with the notices for the public hearings, all the revenues in a county budget except cash brought forward should be budgeted at 95%. That's primarily because of your property tax collections. You never collect 100% of your property tax levy. What happens is, as you go through the collection process, the tax collector receives a commission of about 2%, and the statute provides for discounts depending on when the taxes are paid. And so between those two factors, you're never going to get 100%. So the statutes give you an allowance to reflect that and say you need to budget at 95%. And that applies not just to property taxes, but to all revenues. There's a lot of revenues that don't necessarily have that same kind of discounting problem that property taxes have, but this is, I think, is sort of an archaic provision, and it dates back to the time when property taxes were pretty much the only source of revenue for county budgets. And again, there's additional legal requirements in statute 200.065. The budget has to conform to the uniform chart of accounts that's established by state government. And this uniform chart of accounts generally will give you a series of numbers. And these numbers, typically, if you look at any budget line item, it will have about maybe 10 to 13 numbers. And this is a code which allows you to align all of your expenditures in a consistent fashion, and every government uses it, so you can compare more easily one government to the next. So these codes are set up to identify financial categories in these areas: transportation, culture and recreation, general government, human resources, public safety, reserves, debt service, and interfund transfers. Now you might have a fire department. That's your fire department, and when you look at a budget, you think about the fire department. But if you look closely at the line items for the fire department, they're going to have this coding, and the coding is going to put them in the public safety category. So you might not have a public safety department. You could have a fire department, a sheriff's office, and a number of other activities. But even if you don't have a department with that name, your accounting codes will give you the information needed so that you can group and aggregate the budget expenditures into those categories. Some of the best practices that we all should be trying to follow, and in smaller governments it's hard to always follow the best practices, but it's good to have a fund balance or reserve policy to make sure you've got some working capital. In county governments, we start our year on October 1st, but we don't get our revenue, most of it, our property taxes, until November and December. So you got to make sure you've got some cash to get you through those 2 months. Or if you have some bad weather, a hurricane or something, it could disrupt your property tax collections or other revenue collections. So you have to have some operating cash. And generally the suggestions are that you have between 5 and 15% operating cash. So when you take your overall cash flow needs, if you can set aside 5 to 15%, you're pretty much within the parameters. Some places have quite a bit more than that, and there's nothing wrong with that. Sometimes, as we went through the economic downturn, for instance, if you had some extra reserves, it could have helped you get through the bad times without having to lay off as many people or cut important services. It's good to try to do some multi-year and realistic financial forecasting. Again, in a smaller county, it's going to be difficult to do that because you need staff to do it. It's good to have monthly or quarterly financial reporting and monitoring. Now, this does not have to be provided to the county commission. It's up to the county commission what they want their policy to be on that. But somebody needs to be looking at the budgets and expenditures on a quarterly basis. Maybe it would be your county manager or at least department heads, but someone needs to be looking at that. Also, it's good to have policies on non-recurring revenue. For the most part, you don't want your one-time money going to support continuing operations, because you run out of one-time money and then the next year you're in a hole. It's also good, there are also policies that relate to an annual budget as opposed to policies that you want to keep from year to year. And so when you look at those things that you might want to establish for an annual policy, for instance, you might say, well, this year we want to reduce our property tax rate. Or this year we want to prioritize public safety. It's good to establish those policies early in the process so that your staff has direction to establish the budget accordingly. If you make those policy decisions late in the process, then your staff might have to go back and redo the budget in order to conform to your policies. It's good that you make sure that what your goals are transparent and clear. You should think about pay-as-you-go funding for capital projects. If you can, make sure you've got some money allocated for that. There's nothing wrong with borrowing, but when you borrow, you get into the realm of satisfying bondholders, talking to rating agencies, and they'll be very interested in your policies, and they'll also be interested in seeing that you have a mix of different ways to finance capital improvements. It's good to have a 5-year capital improvement plan, and when you plan for capital improvements, it's important to think about what's it going to cost to operate this building or this park or whatever, or this fire station, what's it going to cost to put your fire services in there when you're building or before you budget for your capital projects, because it's really part of the whole package. You can't do one without the other. The budget is also a chance to communicate with the public. And if all you see with your budget is a bunch of numbers, pages and pages of numbers, you're missing out on an opportunity, because a lot of the public is not going to want to get into that, but you still want them to understand what you're doing. So it's good to have a way, along with your budget, whatever the numbers might be, to have some communication that goes along with it. It could be in your budget document. A lot of budget documents have a mix of narrative explanations along with the numbers. It's also good to be consistent throughout the budget, so it doesn't look like you're treating things on an ad hoc basis or just dealing with issues and crises as they come up. It's good to try to plan ahead for things and try to be consistent throughout to the extent that you can. Budget policies should also, now we're getting down to the staff part of it, but there should be a defined budget process and instructions for the departments to follow. County Commission doesn't necessarily have to get involved in this, but these are things that your staff and administration should be doing. They should be watching carefully to be sure that they can maintain adequate reserves, forecasting fund balances, looking ahead to see what their debt issuance and debt management practices should be. Investments are important, even though if you're not a charter county, the clerk is probably doing your investments, but the Board of County Commissioners adopts the investment policy. So the Board of County Commissioners can tell the clerk how to invest money. Now, regardless of what our policy is, we're very limited really with what we can invest in, and typically you'll see your investment yields have been extremely low over the past few years, and it's hard to do much better than what we're getting, maybe in the range of 1 or 1.5%, or maybe even less in some cases. It's hard to do better than that without taking risks, and the main objective should be preservation of capital. It should address the capital program. On the revenue side, ideally you want to have policies that suggest that you update your fees and charges on a regular basis. If you want to offset the cost, for instance, of your parks and recreation services, so it doesn't have to be totally funded by property taxes, well then there's a lot of opportunities there to have user fees. And then when you have the user fees, it's good to, number one, apply them fairly and consistent to all the users, but also keep them up to date so that they cover the cost that you're expecting to cover. On expenditures, there's a number of different policies that can relate to expenditures. It could be that you have quarterly reports or quarterly allocations, and you don't want your departments to spend a certain amount or percentage of their budget per quarter. There's a number of different ways to approach policies on expenditures. And then there also should be policies that apply post-adoption. In other words, once you adopt your budget, it's almost impossible to avoid doing budget amendments. And budget amendments are not necessarily a bad thing. Typically, budgets are based on estimates of revenues and expenditures that are done in April and May, and your budget goes into effect in October. So you're looking at an 18-month period, really, that these estimates have to be effective for. So you can't really predict anything with a tremendous amount of certainty up 12 to 18 months ahead. So you're going to have budget amendments, and you should have policies that relate to budget amendments, and how much information does the county commission want to see when they approve a budget amendment? Are there any types of budget amendments that you definitely don't want to see? All those things can be built into the policies. Also, with policies, as much as possible, it's good to have your policies in writing so there's no confusion about them. They should be reviewed and updated on a regular basis. If you produce a budget that has a narrative information along with the numbers, then put those policies in there so the public who's reading it knows what the policies are. They should be tailored to your local government. Just don't borrow someone else's policies and put it out there as your own. That might not work for you. And they should be adopted by the county commission. When you prepare a budget, or when your staff prepares a budget, it has to be implemented so that you can keep your accounting records in accordance with generally accepted accounting principles. Generally, you're using fund accounting, which is a little different. It's a subset of accounting. If you study accounting and take accounting classes, they'll talk about fund accounting, but they probably won't talk too much about it. Generally, if you're studying accounting and even studying to be a CPA, you don't really get that much about fund accounting. It's a specialty, and you have to make an extra effort to become familiar with it that goes beyond the normal accounting curriculum. But a fund is a self-balancing set of accounts set up for a specific purpose. And in counties, typically we'll have a general fund where we fund most of our general programs, the programs that are not or cannot be funded from some revenue that's designed to support it. So you have your general fund, and then you usually have a transportation trust fund. That's where all your money for transportation goes. If you have a utility system, then you'll have a utility fund, and that's designed only for the revenues and expenses of the utility system. And it goes on and on. If you have a tourist tax, you're going to have a separate fund for tourist tax. And you could have hundreds of funds in your budget. If you have impact fees, the impact fees will all be in separate funds. If you have capital projects, you'll have one or more capital project funds. And like I said, it goes on. You could have a couple hundred of them. Fund types, there are 8 different fund types. You have governmental funds, internal service funds, enterprise funds, trust and agency funds, debt service funds, special revenue funds, capital improvement funds. They're the most common types of funds that we use. As we get into the budget process, the mission of the budget process is to help decision makers make informed choices regarding resource allocation and the provision of services and capital assets, and to promote stakeholder participation in the decision process. The budget process should provide the forum to review comparative and performance data in a common format, to analyze and debate program merits. It's not just about dollars, it's about priorities. Establish priorities and long-term goals, involve stakeholders, make service level and service cost decisions, and also be sure you focus on results and outcomes. And looking at line items such as travel and office supplies doesn't necessarily help you to focus on the outcome. Are you really delivering effective fire protection services? So you have to, because there's not enough time really with a large budget to look at every single thing, you have to figure out what's really important, and that's a decision that's made government by government, and also commissioner by commissioner. Some commissioners like to focus on those little things, and it's their prerogative to do so. You're elected officials. If that's what you think is important, you can focus on that. But as you get into larger governments, there will probably be less discussion of some of the smaller types of expenditures. We'll be talking now about budget basics. Why do we have budgets? What is a budget? What types of budgets are there? A capital improvement plan, multi-year budgets and forecasting, and methods of budgeting. So a budget is a means to meet legal requirements, set and control spending, provide information to the public and policymakers, educate the public and elected officials, prioritize the needs of your community, outline the expenditures of county spending, and justify and analyze programs and services. Now, Webster's Dictionary provides several definitions of a budget: an itemized summary of probable expenditures and income for a given period, a systematic plan for meeting expenses in a given period, the total sum of money allocated for a particular purpose or time period. Some different ways to look at budgets. What is a budget? Now, the Government Finance Officers Association gives an award for distinguished budget presentation. And it's a pretty ambitious project to produce a budget that can win this award, but when you do, you will have a well-rounded document that talks about a lot more than just numbers. What this document would be is a policy document. You would be talking about your policies, both the long-standing policies and the policies for the particular fiscal year. It would be a financial plan. It would be an operations guide so that someone who's looking at the budget would be able to get a general idea of what operational functions you're providing and how you're providing them, and also a communications device. It would be designed to be user-friendly and accessible to the typical citizen so they could read through it and get a pretty good grasp of what you're doing in your county government. Under a policy document, the budget would explain and follow policy. It would identify services and service levels that will be delivered over the upcoming 12-month period, summarize the challenges that you face in balancing your budget and how you address the challenges. And also, it would talk about your major goals and objectives for each department, your revenue sources, financial trends, operating funds, and expenditure categories. As far as the financial plan part of it, it would outline how much services and programs will cost and how they will be funded. It would provide an overview of major revenue and expenditure categories, discuss the accounting structure and budgetary policies, summarize the capital improvement program and identify appropriations for the capital improvement program, and provide information on bonded debt. In the operations area, ideally, you would be indicating how services will be delivered to the community. It would outline the number of full-time and part-time positions, for that matter, identify department-level appropriations, and also provide a historical comparison, and include one or more organizational charts showing how government is structured to deliver the most efficient and effective services. As a communications device, it should be user-friendly with summary information in text, tables, and graphs. Provide a table of contents, and as elementary as that sounds, a lot of times you'll get into these documents and there's no table of contents and you have to flip through the whole document to find what you're looking for. An index is also very helpful. It should include a budget message or letter of transmittal, and that would come from your chief executive officer, and the budget message is designed to spell out what are the priorities, what's changing from year to year, what's going to be difficult for us, and what do we expect to achieve. Also, now we're required actually to post our budget on the internet. That's a new requirement. It's also good to have executive summaries of your budget, so if a person wants to get an idea what the budget's all about, they don't have to look through a big thick document. They can see something that might fit into 15 or 20 pages that will be easy to understand and provide a lot of the highlights of the budget. And also, it's good to have handouts. You know, in our county, we have a little 3x5 card that shows major budget elements. For instance, what has happened to our property taxes over the past 5 years, what has happened to our total budget over the past 5 years, what has happened to our staffing over the past 5 years, how much of our budget have the constitutional officers used over the past 5 years, and so on. Put it on a little card, and you can take it with you when you're speaking and hand it out to people. It helps people to understand some of the things that are going into your budget. Let's see. Yeah, a glossary of terms is good to have in your budget also, because in budgeting there's a lot of terminology that most people just don't understand. And I guess that's true throughout all of government, but if you have a glossary of terms, it goes a long way toward helping people understand what you're talking about. There's several types of budgets or different ways to approach a budget. For an operating budget, most budgets will be a one-year budget, and that's what's required by the statute. Now, the Government Finance Officers Association, recommends that you try to get into some kind of a multi-year format under Florida statute. Since we can only adopt 1 year, if you're going to have a multi-year format, then like the second year or third year is only going to be sort of a guidance type of thing, because when you adopt your budget in accordance with the statutes, you're just adopting a one-year budget. The capital budget, at least for the upcoming year, is going to be included in your operating budget. If you have a longer capital budgeting horizon, and you're forecasting out several years, your capital budget should not be a wish list just to satisfy everyone that wants to see a new library or fire station somewhere. It should be realistic and actually financially feasible. So in other words, you should be able to fund it. Under your operating budget, the main categories that you'll see there are probably the personal services, that's the salaries and benefits. Operating expenditures would include things like fuel, utilities, supplies, etc. And then you'll have the capital portion of your budget. Also, you will have reserves, and then a number of other categories that are a little more arcane, such as budgeted transfers and things like that. Sometimes you move money from one area to another so that you can expend it in a way that will make it easier to account for and explain it. That way maybe you can keep all of your certain types of expenditures together. If you have a special fund set up, you move money from your general fund to, for instance, a capital project fund, and then you got all your capital projects identified together. A capital improvement plan can run from 5 to 20 years. Although your upcoming year from your capital improvement plan is part of your budget, those out years should be developed, reviewed, and debated separately from the operating budget. It's sort of a separate component. You can adopt it annually, and then each year you drop off the old year and you pick up one new year, which would be the fifth year of the plan. Should be included in your adopted budget document. When you're looking out that far ahead, sometimes it makes sense to smooth out your funding needs so you don't have big peaks and valleys. Try to smooth it out. Now that's what debt and borrowing can do sometimes. If you really have to deal with a peak in capital funding and you borrow the money, you end up with a smoothed out debt service schedule. Just if you're buying a house, if you're buying a house or something, and I mean that would be a huge peak in your personal budget, but you get a mortgage and it stretches it out so you're paying so much a year over the course of the mortgage. And your capital improvement plan should also have a plan for long-term debt if that is needed. The capital improvement plan should also identify where the money is coming from. It could be gas tax, it could just be general fund money, it could be grants. But all that should be identified in your capital improvement fund. It gives you opportunities to develop alternative financing sources because you're looking ahead. So if you see a certain pattern in your capital improvements where you might have to build a new jail or something, that might be the time to start talking about a local option sales tax for infrastructure, because it might be hard to do that if you're just trying to fund it out of property taxes. It also identifies the operating costs of the future capital needs. It identifies future transportation needs, and this is one of the most important areas of your capital improvement plan, is your transportation. And also it would support the capital improvement element of your comprehensive plan. Now, what is a multi-year budget? Well, now this is sort of a formal definition, a document that authorizes a government's appropriations and revenues and spending for 2 or more years. But I've told you that in Florida you can really authorize 1 year at a time. But if you have that second year projected, it still helps you understand what's coming up and what to expect. Some places will do this where they have a rolling plan where they're constantly adding the second year. Other places may do a 2-year budget where you do 2 years, and then the second year is a less intensive budget process, and then after your 2 years you go back and then you do another 2 years budget as opposed to a rolling plan. But you still have to go through the trim process each year. You could have an abbreviated budget cycle in the off years and just focus on refinements and adjustments and other budget related things, and possibly do a little bit of a program analysis and program costing, so you know how much it, focus a little more on how much it costs to run a fire call or something like that. The multi-year budgeting can help you get a greater emphasis on management and service delivery and program evaluation. It gives you a long-term perspective. It can also help you identify problems early. It can help you link operating and capital planning and integrate strategic planning and goal setting into the process. With multi-budgeting, you can smooth expenditures out more easily. Sometimes you can identify cost savings when you're looking ahead. Sometimes it reduces the staff workload in the off year with a 2-year budget. And this is something to consider, and you may not notice it, but the budget process is a workload peak. And often as your staff is working on the budget, as the time comes up to complete that budget, they're going to be working some long hours to get it done. There's a real workload peak there that creates a lot of stress, and it's difficult to it's a real challenge sometimes to get an acceptable budget done within the deadlines that we have to work with. Multi-year budgeting is also viewed favorably by bond rating agencies. When we get into budget methods, almost every budget is based on a line item budget. A lot of smaller governments will have a line item budget, and that's about the extent of their budgeting. You can, though, go a little further and consolidate your line items into programs. You can go further than that and create a performance-based budget, or you can do something entirely different and get into zero-based budgeting. Now, with a line item budget, you're focusing on what is to be bought. It does give you a good expenditure control model. Some people say that, well, when you're focusing too much on the trees, you can't see the forest, and you're just budgeting for these small costs, and sometimes it's counterproductive. And a lot of times the line item budgets are incremental budgets. They're just built on last year's costs, where you take last year and add 3% or something. It is a traditional approach. If you don't have a lot of staff, it's the easiest to develop. But it's not as innovative or transparent as some of these other budgeting techniques. You know, a line item budget, basically there's your line items, and that's what you see. You don't know how many units of service this department is providing, or how fast their response time is, or some questions like that. Now, with a program budget, it might be a little different. Here you're looking at a program, let's say it's development and review. One way that this is done is it actually can combine elements of several departments to give you an idea of what it costs for you to go through your development and review process. Another type of budget is a performance-based budget. This goes a step forward and tries to identify units of service and leads you to the point where you can start to calculate the cost per unit of service. You're focusing on what is to be done and efficiencies. You can see how your spending aligns with objectives and strategies. It identifies what you want to deliver and how much of it you want to deliver, how you're going to deliver it. and it's aligned at a department level, but not organizational. So for example, so here's a performance-based budget where, for instance, let's talk about fire, part of a fire protection budget, fire suppression. Let's say you have 100 responses and your cost per response is $60, so your cost is $6,000. And with prevention, maybe you've got 470 inspections and your cost per inspection is $1,800. Now, take fire prevention. If you're budgeting this way and you want to be able to double the number of fire inspections, then you could assume that it might cost you twice as much. That would be a good way to figure out how can you buy more service and what's it going to cost you. Now, that's not always a perfect relationship between the additional dollars, because, for instance, if you're talking about fire suppression and you want to provide more services, you might have to buy a new fire truck, which would put you up another step on the cost accounting level, but it can still help you figure out what you're getting for your money there, how many units of service. In addition to that, you can also get into an effectiveness measure, because you can figure out what's your response time, and then you can build in information into your performance-based budget that could indicate roughly how much it would cost for you to improve your response time. So that's a performance-based budget. It gets pretty sophisticated. It goes way beyond just counting the dollars. And it's not easy to do it. It's something that you really need a pretty healthy level of staff to do.
What do you do in Manatee?
Excuse me?
What kind do you do in Manatee County?
Well, in Manatee County, we're doing zero-based budgeting right now. But we do have a lot of information on effectiveness measures and performance measures. So it's sort of a hybrid, and a lot of budgets that really work well do turn out to be a hybrid. We've been doing zero-based budgeting since the economic downturn, and it's helped us a lot when it came to reducing staffing and deciding which services we were going to scale back. And it gave us a whole, rather than having to argue about should we cut across the board, should we, there's just so many discussions that you can get into when you're talking about scaling back services. But with zero-based budgeting, we ended up for each department with these little funding increments. Each one might involve, say, 1 or 2 people, and we could go through them and say, okay, well, library hours are not as important as code enforcement. Now, this is something we knew because we've heard our commissioners say that. So we can scale back our library hours by 4 hours a week in our 4 libraries, and then we don't have to reduce code enforcement or animal services. And so you got into those, it made it easier to make those kinds of decisions. And you sort of start from scratch with zero-based budgeting. Most zero-based budgets do not go all the way to zero, but you start at a lower level. For instance, you might say, well, if we want to create a budget for a certain program that is the minimum amount of effort that you can put forth and be effective. In other words, anything less than that, there's no sense having the program. So you start with that, and then you build on these increments. And so if you want your libraries to be open 30 hours a week, this is the cost. You want to go up to 34, this is the cost. Go up to 40, this is the cost. And
if the economy improves, would you change it? And does the zero base allow multi-year planning for you?
Well, it does, but it gets tricky because a lot of times, once you eliminate something and maybe you have to lay people off, you just can't put that back in the tube, Like sometimes when you reduce something, it's a lot harder to put it back into play again. You make some decisions that are almost irrevocable, especially if you vacate a building, and then the discussion becomes, well, let's sell this vacant building, and then 4 years later the economy gets better and you say, if we had that building, we could open up a library again. But all those discussions come into play. And again, Zero-based budgeting takes a lot more time, and you have to start out, with all of your departmental staff working on these different ways to show their budget. So they need training, you need to adapt your computer system, and so it's not something that you can say in March, let's do a zero-based budget for the budget that we're going to have this to review this summer. That would be difficult to do. Yes, sir.
Do you think the zero base gives your board greater understanding of the true unit cost then to go into your cost model?
Yeah, very, very much so. And what we did was, when we produced our zero-based budget, we had 800 pages of information, and there's an awful lot of information in there, and they weren't necessarily interested in seeing all of it, but it was all there in case there was a question. And so each one of these little increments of service had a page of data about it.
So your activities would have labor, equipment, materials defined, and they could look at that level of detail? How far?
Yeah, well, they didn't really get to that level of labor, equipment, materials, but it was staffing, and it was like, library hours, for instance, not to pick on libraries, but it's a good example because it's something that you really can take increments of. And they could see, we started, of course, as we always do, with a staff recommendation, but the staff made the recommendations when the administrator recommended his budget, and when the county commissioners looked at it and saw what choices the staff made and the county administrator in terms of, we'll reduce this and not that, it really held up pretty well. So.
Can you departmentalize it? Some departments are pretty much standardized, they just go from year to year to year with perhaps a little increase. But if I wanted to tear down a particular department, or
Yeah.
the board, whoever, fire department, and we wanted to use zero base for that, but not line item for others, is that permissible?
Well, sure. I mean, it's your budget, and that's a pretty good suggestion, because it may be that because of all the effort, it might be an issue of materiality. Let's go where the big dollars are, and we'll zero base that. But there's only 6 people in our human resources department, so if we can go through all that work, and we all know what human resources anyway. But yeah, so you certainly can, or you can rotate, and one year do 3, the next year do 3, and the next year do 3. So yeah, there's a lot of different ways to go about it, no question. Yeah. Now getting deeper into legal requirements, Florida Statute 200-065 of the Florida statutes lays out the budget process for counties, school boards, and most other governmental agencies. And it gives you a process, a time frame, advertising requirements, and so on. And it defines who does what, and the method of fixing millage rates, and the millage limitations, the trim process, and the only thing that would override 200-065 is if you have a county charter that says that you should do something different. Now, when we talk about what's in the statutes, that really starts the process as you are involved in it, because a lot of work goes on from staff before this, but the county commission really becomes involved around the 1st of July, and the other constitutional officers also, because the property appraiser certifies the taxable value on July 1, and this is the taxable value as it existed as of December 31st of the previous year. So basically, your property taxes are levied in arrears, and the people owe property taxes from the previous year, January 1 through December 31, for instance, of 2012. When we do our budget and send out our tax bills next November, people are paying property taxes for the value of their property as it existed last year. So they're paying property taxes in arrears. A lot of times people don't realize that. It's a hard concept for people to grasp, especially when, for instance, values went down. And people would come in and say, well, here it is, it's July of 2013, and my property is only worth $100,000, and you have to say, well, the property appraiser said that it was worth $140,000 last year, and that's what this whole thing is based on. But that's what the law says. Now, within 15 days of that, the county budget officer has to submit a budget to the board. Now, we don't develop a budget between July 1 and July 15. We've been doing it for months and months and months. But the thing is, now these days, a lot of counties are getting their budgets out, even though they don't know these specific numbers. A lot of counties are getting their budgets out earlier than July 15. And ours, for instance, we put it out at the end of May. And this gives the board more time. And you may not have precise numbers, but it's enough to start the dialogue and the informational part of the process. You have to, if you get your budget out early, you have to adjust it after you get this July 1 information. But a lot of places are trying to start their process earlier because there's been more difficult decisions to make as we have had the economic downturn. Then after that, the county budget officer submits the budget, and then the Board of County Commissioners will typically have work sessions, and by August 4th, you have to set the tentative millage. So once you set that, you can change it down, but it's very difficult to change it up. And that millage that you certify early in August then is the basis for the trim notices that every property owner gets later in August. And everyone that owns property will get a notice in the mail from the property appraiser, and it will tell them what your taxes would be if these millage levies are levied, and what your taxes were last year, and you can see if they're going up or down. And these trim notices try to put a lot of information into a little bit of space. They're very confusing, and every county just about asks, well, you know, this form is so hard to understand, and people are always asking questions that aren't answered by it. Why can't we do something different? And the answer is, unfortunately, you can't, because it's all laid out by state law. The property appraiser has to use that form. And if you want to provide additional information, then possibly you could send out a different mailer, but the property appraiser is very limited as far as what he or she can put into that form. Then after the trim notices go out, within 65 days after July 1, you have to have your first public hearing on the tentative budget. And at that hearing, you have time for public comment. Then the board can discuss the budget and the millage, and then they will vote on what they want to adopt as their tentative millage rate. And once you have a tentative millage rate, then you have to publish an advertisement in the newspaper that shows your summary budget and your tentative millage rate and the extent to which it is a property tax increase or not a property tax increase. Now, the way they define a property tax increase is a calculation known as a rollback calculation, and it's gotten to be pretty complicated, but what it really is in its simplest form is they try to create an apples-to-apples comparison so that if you were to have the same amount of taxable value in your tax base this year as last year, and you wanted to bring in the same amount of money, what would your millage have to be? And what you can get then, if you want to go to what they call a rollback rate, is you get a revenue increase from the new construction in your county, but otherwise you have to reduce your millage if your other values that are not new construction have gone up. Now, most places will have been satisfied more or less to keep their millage the same from year to year. But if you really want to meet the rollback requirement hard and fast, then probably you have to reduce your millage. Now, there's been exceptions, of course, because over the past few years, property values have gone down. And when property values go down, it means that your rollback rate was actually a higher rate. So you could actually, because when they wrote the law, they never thought that property values would go down. So you could actually increase your tax rate, and it wouldn't be called a tax increase, which is also difficult to explain. But that's what the law said. So.
Weren't they going to change that term? Wasn't there some talk of changing rollback?
Well,
More generic?
yeah, but every time they try to change this, they usually make it messier than it was before. So then after you adopt your tentative millage, though, you put the advertisement in the paper, and then you have to advertise in the paper not less than 2 days or more than 5 days before the second public hearing. And you have to, 15 days from the first one, you have the second one, and that's when you adopt your final budget. And again, you can't increase your millage rate over what you put on the trim notice unless you send out a second notice to all the property owners. So you can do it, but that's not something that anyone wants to do, have to send out that second notice. So a typical budget calendar might look like this, where your staff would start out in January or February trying to do some kind of an economic forecast, figuring out what's happening with your revenues and your tax base. And then you would want to identify your priorities. Now, this priority setting process is something that some county managers will take to their Board of County Commissioners and have the Board of County Commissioners make some sort of a formal policy decision. In other cases, the county staff might just try to discern from their experience what the priorities are and brief the commissioners or use some other method. You know, March and April, generally you'll be developing and reviewing the departmental requests. In April, May, or June, the county administrator would be looking at those requests and making the final decisions as far as his or her priorities are concerned. And then in July, you produce the proposed budget. In July and August, you have work sessions. In August and September, you have the board making changes or not making changes and adopting the budget in accordance with the trim process. September, public hearings and adopted budget. And then once you adopt the budget, you may have budget amendments and budget monitoring occurring. Now, from the commissioner's point of view, again, it varies. Different counties have different traditions. In smaller governments, generally commissioners become involved in a more detailed fashion in their budgets. Let's see here. So we'll talk a little bit about that, because ultimately, regardless of how deep you want to get into the budget, there are some clear responsibilities that you have. You want to ask questions, but make sure they're good questions. There's some things that might be good to avoid. And then also there's the issue of budget monitoring and reporting. Geez, this thing. You know, as you get into the budget process, some things that I think are good practices for commissioners to follow are number one, be careful that when you look at departments or elements of the budget, it's always good to reward good performance and good practices and try not to penalize them. That creates a lot of problems with staff morale. Everyone's got their reasons for doing what they want to do, but you just have to keep in mind that if you have successful programs and successful managers, keep that in mind when you're reviewing their budgets. Not that you're going to give them more money because of it, but at least don't penalize them. Try not to talk about ambitious capital projects without remembering that they're going to have operating costs down the road. A big problem that a lot of places have had in recent years is deferring maintenance on capital assets. That can really get you into trouble. I heard a commissioner yesterday talking about the fact that their sheriff hadn't replaced any vehicles in 5 years, and now it's time to pay the piper, and that's going to be a lot of money. Those types of things can really come back to bite you. They might save you money in the short run, but be careful. Using one-time revenues to balance the budget is another thing that can go back to bite you. You know, we've done it in our county, but we had a plan so that we tried to schedule our use of one-time revenues so that they would run out at about the same time we thought that our property values would come up and we wouldn't fall into a deficit or a hole. And so we think we're going to come in with a soft landing. But you could just go off a cliff if you're not thinking ahead to where you're going with that. Implementing across-the-board cuts can be a tempting way to get some quick budget cuts, but sometimes that penalizes your best programs, and it rewards the programs that are maybe overfunded or not too careful about how they're handling their budget. Too strict line item control is another thing. It could save you money in the short run, but sometimes in the long run, it can create problems. And borrowing to balance the operating budget is, I don't think it's done very much anymore, but it's another thing that is really something to stay away from. It's a very bad practice. Now, Commissioner's role, it's up to you. You can set your policies on how you want to monitor the budget. How do you want to handle budget transfers after the budget is adopted? In larger governments, there's a certain amount, and the statutes allow for certain things to be delegated to the county manager, but you don't have to delegate them if you don't want to. It's up to you how closely you want to watch those budget transfers. In a larger county, there's bound to be a lot of them, and typically it is delegated. In a smaller government, you might want to keep a close watch on that. And the same thing with budget amendments. It's up to you to have your policy on that. But keep in mind, what level of detail you want to make your staff responsible for versus what you want to come to your level. Because it's hard to hold your staff accountable if every time they try to make a decision they get overruled. Because then what happens, if the county manager makes a decision and makes a recommendation, basically the county manager is saying, this is my recommendation and I'm willing to be responsible and accountable for making this work. Then if the county commission overrules the county manager, then the county manager really isn't responsible and accountable anymore because his recommendation wasn't accepted. So the county commission gets what they want, but if it doesn't go right, there's nobody to hold responsible for it. Something to think about. Commissioners, again, you might want to see monthly and quarterly reports, financial models and trend monitoring, and that can be particularly interesting to see, what do we think is going to be happening 2 or 3 years from now. Commissioners may also want to see information on the number of positions. There are some places where you cannot add a position in the budget unless the county commission approves it. Other places delegate a little flexibility to staff. And there may be other special reports based on local issues that you want to see. In our county, for instance, we provide quarterly reports to the board on major capital projects, not just spending versus budget, also what's the current status, are there problems getting permits, are there issues with citizen concerns and so on. So there's a number of different types of reporting that you might want to see. And then finally, I'll talk a little bit about constitutional officers. And it's interesting, for a lot of counties, the constitutional officers, their budgets could constitute 50 to 75% of your total property tax dollars. And yet when it comes to scrutiny and accountability, it's all on you and never on them. They just seem to get a free pass when some of those issues come up. And that's just a fact of life. We have to deal with it. But there's nothing that would prevent you from establishing certain policies that you might want the constitutional officers to follow when it comes to budgeting and finance. Now, they can refuse to follow them, but if you establish the policies and they don't follow them, it's sort of on them for not participating and not being a good steward of the taxpayers' money. So, this is the area, though, where scientific methods and careful calculations suddenly disappear, and it can become very political. But it doesn't mean that they always have to rule the roost, because ultimately the county commission is in charge of allocating the dollars for their budgets, and not to mention that the public is always going to be looking to the county commission when they're thinking about their property taxes, and they rarely think about the constitutional officers. So it's been there's a lot of potential for adversarial things that come up there. But there's things that you can do. You can cite your expectations. And there's some places where, if you look, you can probably find some good examples of how counties have tried to do that. And that concludes what I have to say. So thanks, we've had some good questions, and if there's more questions, go ahead. There's got to be some more questions, right? Thank you.